Say you just robbed a bank. Congratulations, you're sitting on $2 million in cash. Here's the problem nobody tells you about in the heist movies. You can't spend it. Not on a house, not on a car, not even on dinner at a place nice enough to ask for a card instead of cash. Because the second you try to buy anything that matters, someone's going to ask the one question dirty money can never answer. Where did this come from? And I found it doesn't survive a mortgage application. This is the oldest headache in crime, and the fix criminals came up with for it is so audacious, so widely used, and so quietly built into the global economy that once you see it, you can't unsee it. It's called money laundering. And by the end of this video, you'll understand it well enough to recognize it in the news, in your city's skyline, maybe even in your own bank's fine print. Let's start with a name. Call him Alex. Alex isn't real, but everything that happens to him is, pieced together from real cases, real investigations, real court documents. We're going to follow Alex's $2 million through the entire system, stage by stage, so you can see exactly where it goes. First, what makes money dirty in the first place? It's simple. Dirty money is money the government never got its cut of. Drugs, fraud, bribery, tax evasion, doesn't matter the source, it all has the same problem. Every dollar that moves through a bank, an investment, a purchase, leaves a footprint.
And investigators don't chase money, they chase footprints. So the entire game of laundering comes down to one move. Take money that's screaming, "I came from a crime," and teach it to whisper, "I'm completely normal. Please, look away." That's it. That's the whole con. Alex's $2 million is about to go on a journey through 3 stages, and each one solves a problem the last one couldn't. Stage 1. Placement. This is the part that gets people caught, because Alex is holding something the financial system was built to notice.
A physical pile of cash with no explanation. Walk into a bank with a duffel bag holding $800,000 and you're not getting a teller. You're getting a phone call to the FBI. So Alex gets creative. The classic trick is called smurfing. Nothing to do with the blue guys, everything to do with staying invisible. In the US, any deposit over $10,000 gets automatically flagged. So Alex doesn't deposit $10,000. He deposits $9,800, then $9,500 somewhere else, then $9,750 at a third bank on a different day under a different name if he can manage it. Some operations actually hire people, literally called smurfs, whose entire job is walking bank to bank, making deposits just small enough to stay under the radar. It's slow, it's tedious, it is, somehow, the most boring job in organized crime. The other route? Buy a business that already deals in cash. Nobody double checks. A car wash, a restaurant, a bar. Nobody's auditing whether you really served 400 customers last Tuesday. So you say you did. Mix the real receipts with the fake ones and deposit the whole blended pile as an ordinary day's business. The money doesn't look dirty anymore. It just looks like tips.
But here's a third option Alex could take, one that barely touches a bank at all. Casinos. Buy in with cash, play a few half-hearted hands, cash out your chips as winnings. On paper, that's not drug money anymore. That's gambling income, and there's a tax form for exactly that story. Investigators have a name for casinos used this way. They call them laundromats with slot machines. And there's a fourth option that's grown faster than any of the others in the last decade: crypto. Buy Bitcoin with cash through a peer-to-peer trade. Run it through a mixer that blends thousands of users' coins together so no single trail survives. Then cash out on an exchange with looser rules in another country. It's placement and layering in almost the same motion, which is exactly why regulators are still playing catch-up with it. But getting the money into the system is only half the fight, because now it's traceable, and traceable is still dangerous. So Stage 2 exists to solve the problem Stage 1 couldn't. Stage 2, layering.
The goal here isn't to hide the money. It's to make the trail so long that whoever's following it gives up before they reach the end. Alex wires it from a bank in one country to a shell company in another. That shell company loans it to a second shell company somewhere else. That one invests it and sends the returns back as dividends to a personal account, often right back where it started, just wearing a different disguise. Do that 4 or 5 times across 4 or 5 countries, and even trained financial investigators lose the thread. That's not a side effect, that's the design. The tool that makes this possible is almost embarrassingly simple: the shell company. A company that exists entirely on paper. No employees, no office, no product, sometimes not even a working phone number. Just a name, an address, and a bank account. And you don't need a criminal mastermind to build one. You need about $500 and an afternoon in Delaware. Yes, that Delaware, 3 hours from Washington, D.C. Set it up right, and the real owner's name never has to appear on a single public document. So when an investigator finally gets close, here's what they find. A company owned by another company, owned by a trust, managed by a lawyer who can invoke privilege, registered in a country whose entire business model is not answering your emails.
Now here's the part that should genuinely bother you. This isn't just small-time criminals in back rooms. In 2012, HSBC, one of the largest banks on earth, admitted to laundering hundreds of millions of dollars for Mexican drug cartels and paid a fine of just under $2 billion to settle it. No one went to prison. The bank's own profit from the years of looking the other way was reportedly larger than the fine itself. A few years later, investigators found that roughly $200 billion in suspicious transactions had flowed through a single tiny branch of Danske Bank in Estonia. A branch with about a dozen employees, processing money that should have needed thousands of people to move that fast. $200 billion through a branch office? That's not a criminal underground. That's a load-bearing wall of the global economy. Which raises the real question. Why would a bank ever let this happen? Because for a long time, the math simply favored looking away. A fine, even a billion-dollar one, is a line item. Losing a client who moves that kind of volume is a much bigger hit to the balance sheet. That's starting to change, but not because banks suddenly grew a conscience. It changed because regulators finally started threatening something banks actually fear.
Individual executives facing personal criminal liability, not just corporate fines paid out of shareholder money. Which brings us to the finish line, stage 3, integration. The money's in the system. It's been dragged through enough shell companies to lose its own scent. Now it needs to come home clean, dressed up as something Alex earned, ready to spend on the yacht, the penthouse, or just a very comfortable retirement nobody questions. Here's how that last step usually plays out. First, real estate. Buy a condo in Miami or London through a company nobody can trace back to you. Sit on it for a year. Sell it. Congratulations, the $2 million is now profit from a property investment. This is, by the way, a real reason so many luxury towers in major cities sit dark at night. Nobody's living there. They're just laundering moonlight. Second, art. A painting sells at auction for $50 million, and not one person in the room was required to ask where the money came from. Nobody's checking if it was actually worth that.
The art world runs almost entirely on reputation and silence. Buy, wait, sell. And somewhere in that transaction, dirty money quietly became an appreciating asset. Third, trade-based laundering. The method most people have never even heard of, which is exactly why it's the most effective one left. Here's how it works. Alex sells a shipping container of cheap plastic patio furniture to a buyer overseas and invoices it at 10 times its actual value. The overseas buyer pays the inflated invoice, wiring the difference as if it were a completely legitimate trade payment. Customs sees a container of furniture crossing a border. Nobody's cross-checking the price of plastic chairs against an invoice. Global trade moves trillions of dollars a year, and the paperwork is so vast that a few $1 million hidden inside inflated invoices is a needle in the largest haystack on the planet. Fourth, insurance. Buy an expensive life insurance policy with dirty cash, pay premiums for a while, then cancel it early and collect a surrender value as a refund from a completely legitimate insurance company. Clean check, clean source, no questions asked.
So, after all 3 stages, all these methods, all these dead ends built on purpose, how much of this is actually happening right now while you're watching this video? The UN's own estimate puts global money laundering somewhere between $800 billion and $2 trillion a year, roughly 2 to 5% of the entire world's GDP. And of all that money, how much do investigators actually manage to seize? About 1%. 99% gets away clean. If any legitimate industry ran a 99% success rate, we'd be writing case studies about it in business school. In this industry, they just call it Tuesday. So next time you walk past a dark, empty penthouse tower, or see a painting sell for an absurd number nobody can explain, or hear that some bank paid a record fine for something that sounds suspiciously like this, you'll know exactly what you're looking at. Not a mystery, a machine. One that's been running in plain sight the whole time. And if you want to see what happens on the other end, how investigators actually catch the 1% they do catch, that's a whole video on its own. Follow along, because that one's coming next.